Hey world, it's being want to come back with another video. Friend, I want to come back with this quick video here because I wanted to do what they call a clarity video. Because you hear a lot of people talk about the economic recession is coming, the stock market crash is coming, all this economic bad news on the horizon, right? But no one actually ever gives a reason why. Right. Now, even myself had said that there's going to be a recession. If you didn't get a chance to watch my last video, guys, save your cash for the crash. I say that because there are certain things that happen within this type of economy that happens all the time, which gives people that are financiers, hedge fund managers, those that have a lot of money, give them indications of when the market is going to pull back or correct or go into a recession or depression, like what happened in 1929 with the Great Depression. Remember, you didn't get a chance to watch my last video. The Great Depression, that crash was built off of debt. Okay? So many people were in debt. And if you didn't, and like say right now, we have $4 trillion worth of consumer debt. That's credit cards, mortgages, auto loans. $4 trillion of debt. Now, you remember, if you're in debt like that, then, of course, you're not investing your money because you're in debt. You dig? But those that are investors, all right, that's not cognizant of these indicators. Because Warren Buffett, one of the greatest investors of all time, he has an indicator called the Warren Buffett indicator, which basically kind of gives us a forecast of when this recession is going to happen, or when there's evidence that a recession is going to happen. And it's basically the market capitalization to GDP. Now, what does that mean? The market capitalization, family, is the value of the entire stock market. The money value of, like, all the money added up that people invest their money in these companies. If you add up all of that money, that's market capitalization, right? Market capitalization to GDP. Now, GDP, of course, is economic growth. How much goods and services are being, bought and sold throughout a year or throughout a quarter. Well, and gross and GNP, which is gross national product. That's actually the calculation of growth all over. So it's international. Like Ford has companies overseas. Well, those cars they sell overseas or whatnot, that is basically calculated in the United States GNP, which is the gross national product, right? GDP, gross domestic product, is all goods and services sold here in America. Well, if the stock market prices are way higher than the GDP, then what they're saying is that a lot of people paying or overpaying for stock prices right now. And there's another indicator called a PE ratio, which is price to earnings ratio. And all that basically means, family, is the price people pay for a stock in relation to the earnings of that company. So to put it in layman's term, would you want to invest in a company that's not making any profit, that's not making any earnings? No. You want to invest in companies that are making earnings, that's making profit, making revenue, that's able to build the company, able to dole out dividends. But you can't do that if the company isn't making money, right? You really can't justify investing in the company, because see what happens if a company isn't making money and they have the same operating costs, the same marginal costs, and if their marginal cost is higher, and what that means is everything that they using to, purchase the product they're selling is costing them more and more and more. So if that's the case, then eventually they're gonna run out of money. And if you're a shareholder and investor in this company, then eventually that company is not gonna do well. And so that's where we're at right now, family. So when President Trump says that this is the best economy ever, yeah, in reference to the market capitalization, in reference to the millions and millions of dollars that's in the stock market. But it's unjustifiable because these companies aren't making money. Just look at their PE ratio, the price to earnings ratio. Okay? You paying, like, if it's, and let's just look at the stock market, the S&P 500. On average, the S&P 500's PE ratio is around 15% in the last 15, 20 years, 15%. It's way over that right now. So that means people are paying a lot more money for the lack of earnings that these companies are making. All right? And that's when it's time, when people are going to eventually find out what's going on. And then it's going to be like kind of a self-regulating disaster where everybody's going to start selling and selling and selling. And then that's what's going to drop the market. And that's when people that's been paying themselves first, paying attention to geopolitical news and economic news, and understand these indicators, that's when you're going to get wealthy. All right? So, fella, I just want to come back with a quick video. In the meantime, between time, may the most high sorry to bring you joy. Make sure you like, share, and subscribe. Push the notification button. And being Will is out of 5,000.